All right. So now we're live,
We're
but
live.
we're gonna let
We're
it kick
live.
in for a minute. Yeah.
Hey there, buddy. How are you? Bo, good to have you back, buddy. And me too. I'm glad to be back. We've been busy with so much stuff going on, but it's exciting to be back here with all our followers and our friends and all the great people that we know right here in the Bay Area, California. As you guys know, this is Vinney Chopra and my friend, good friend, Beau Eckstein, the TV star, HDTV star, and a great broker and investor and flipper, and I mean, many, many things. And here I am, Vinney Chopra, who actually has been investing in single family homes for over 35 years, but jumped into the gun with multifamily. And that has been a rocking and rolling world for Vinney Chopra for the last 14 years. That's like almost 15, 14, 15 years back when I became a broker in California. But I didn't want to sell single family and homes like that, but we just wanted to get into investing into apartments. So that's what we talk quite a bit about. Hi, Bo. Good morning. How are
Good
you?
morning. We already got Derek Clifford, and he commented, "Hey guys, hey Derek, if you have any questions, I know you already spoke to Vinny, but feel free to ask questions, guys, because we got Vinny here to answer your questions, and I can answer your bridge loan financing questions and some
Yep.
basic real estate stuff. But we got the expert Vinny in the house, so feel free to ask questions. The other thing is that if you have not bought your ticket for REI Bar Camp, I know
Yep.
you have, Eric, so we're looking forward to seeing you. It's it's coming up, not this Saturday, but next Saturday, the 28th. We have lots and lots of people going. We have lots of exciting speakers and leaders that are going to be leading great discussions.
Yep.
And there's always great networking, and that's how deals get done is through meeting people that take massive action, and then put the people together that take massive action, and then you get success.
So true, Bo. You are so right. And congratulations to you. I know this is your annual event. You do it. And it's so exciting that you are able to gather great speakers like David, Green from Bigger Pockets. And thank you. I'm there. And then we have a lot of other great speakers. You want to say some names? That'll be
Sure.
amazing.
We got the short-term rental king, Al Williamson. He's awesome if you want to learn about short-term rentals, right? Because even
Yep.
on your multifamily, you could start possibly
Doing
furnishing
some
some of those.
Airbnb on some of
Yes,
the units. You bet.
and
Definitely.
he's got a
Yeah.
great outlook on that. We have Daniel Blue, who is an IRA specialist. He helps people learn what they can do with the retirement funds, things that they didn't know they could do, like self-direct, but also the Rob's plan, where you can take your retirement and roll it into a business. So there's a lot of things that most of us don't know, and he's going to be there. We have Daniel Ramsey, who has a virtual assistant staffing company specializing in for real estate and real estate investors. He's
Yeah.
got 1,000 employees in the Philippines, and he's going to be talking. He's got a great business mind. We have, we have so many people. We have a real estate developer named Chris Porto. We
Yes.
have Tommy Christie. He's personally
Tommy
bought over
Christie.
20
Yes.
2,700 homes. Okay.
Looking forward to meeting him. Tommy now from Go Abundance. Oh my
Yeah.
gosh. That's
We have,
amazing.
yeah, we have, God, we have so many people. We have Leo, who is a business funding specialist. He started in his garage, and he figured out how to get lines of credit unsecured, and he turned that into a $5 million business, which is pretty impressive, starting with nothing. So he's going to talk about entrepreneurship and setting up the right entities and funding your businesses. We've got David Green, obviously, is going to be talking about all different things, and he'll be kind of emceeing. And then we got Vinny, who's going to running some breakout sessions and also doing our key motivational talk during lunch. And lunch will
Yes.
be provided. We have a lot of
Yes.
guests, a lot of exciting guests that are coming. Some of Vinny's friends are going to be in the house, like
Yes.
and they could talk about oxygen and all the things you guys got going on over there. I mean, it'll be good. It'll be really good. Anytime you get a bunch of motivated people, whether they're experienced or not, but people that want to take action and learn and then implement, it's gonna, it's the kind of the keys to success. So this is a really good event. I hope to see all of you guys there. And then today, the topics for today's
I
Vinny and Bo
apologize,
show.
Bo. I've been kind of holding this iPad in my lap. I don't want to show around or anything. I'm just trying to center myself. I want to qualify. My head is getting cut off in the picture. So I'm right here. I'm right here with you. You bet, buddy. Let's go.
Okay, so today's topics are: do I have the right real estate investment tools for buying multifamily homes for investment, and understanding multifamily investment property returns and benefits. So that'll be talking about things like IRR, cash on cash returns. And then we're also going to break out and talk about all the free resources where you don't need money to get started. What you need is time and take the time to learn the underwriting systems and the tools you can use on Google and things like that for free.
Yep.
And then we could probably also do them a favor and send them to that training you have where you actually let them use your dummy down deal analyzer,
Oh yeah, for sure.
right? We can
Sure.
maybe have them opt into it so they can get it for free, maybe, or we'll give them some tool, something,
Totally. We will.
something you got.
That'll
We'll
be
give them at
awesome.
the end of this so they can see, because it really comes down to having the tools or no, having the tools and having the right mentor to help you navigate the waters of real estate. Because every deal you learn something new. I mean, even after you're doing 27 syndications, $300 million of real estate, I'm sure you keep on learning, right? You never stop.
That is so true, Bo. I totally agree with you. I remember it took me 11 months to buy my first 14 units, but that was the best time ever because it took me 11 months, but I learned so much in the process. So that's what I'd like to mention to all the audience, who'll be watching us later on or who are already connected with us and so on. Please don't give up. Don't give up because you got to just keep looking at and having that burning desire that you're going to perfect this system, you're going to learn ins and outs of this business. It's not that hard. See, investing in real estate or single family home, it's just that we have 14 units, 14 houses into one place. Just think that way. It's only one transaction. You have to qualify for only one loan, not 14 different ones. You have to have, maintenance of the 14 units, at one place rather than moving all around. So let's talk about it. What do we need to do to really find the right property? Which I say now we are not talking about 14 homes in different cities or economic, areas and all that. So we need to determine the right pocket. That's the word, right pocket of the MSA metropolitan area. If you're in the Bay Area, of course, as you know, it's very, very expensive here. Very expensive. I mean, the per unit price of a apartment complex per unit, I'm saying, could be as high as 300, 400, 500,000 just for that if you're looking in the nice area. That's why we invest outside California. Many of you know that, and you have done it successfully. Bo, you are very successful in Indianapolis and Indiana and South Bend and all. I have been very successful in Texas for the last 14 years, and Georgia and Florida and other places, Arizona also. But the key thing is we need to first find a good area where you can start building relationships, I call it, to find the investors. I mean, for investors who will take their money there to invest with you, one thing. The other thing is the deal. You need not only the money, but you need a good deal, which is going to get the investors excited about coming along with you, right? So, all those things are very, very important. So, let's talk about deal analysis, like you said. So, what we try to do. let me explain everything in my academy also. I explain very nicely and clearly through different lectures, like Bo said. And I would love if anybody wants to go further, please do text the word. Like, if you're listening to us right now, it will be very easy to just text the word learn, 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 to 474747. Just say, text the word learn to 474747, and my business advisor, John Rusin, will be getting in touch with you. But let's go into now. So let's just see, how do we determine what's the right place? Let's go to Atlanta, for example, or maybe anywhere you want to go. San Antonio. I know we were having Derek, and we were just talking this before the call. And any MSA, you want to talk to the brokers, real estate brokers who sell multifamily, and the property management companies local to that area that manage the multifamily also. Now, I want to put a caveat to it. Please only disturb, remember the word, you only disturb the brokers in the same amount of units range that you can afford. Do not take the time to talk to brokers who are selling 200 units, 300 units, and you can only afford 50 units or 60 units. Please find out by going on LoopNet. LoopNet, I don't suggest too many properties are good on LoopNet, but it's a good place. It's a good place to start. It's free. CoStar bought LoopNet, but you can actually go to LoopNet in any city. You just say, give me the multifamily, units and so forth. You'll see who are the brokers who are selling in the lower categories. Again, please, if you're thinking about a particular part of the city, go ahead and find the zip code. Listen to me again. Zip code is so important, because if you talk to the brokers and the property management companies, they will tell you which part of the whole metro area there is path of progress. That's the word. Path of progress means there are certain areas of the town which are getting more people moving in. That's what it is. It's extending towards the northeast, or it's extending more towards the southeast or southwest, whatever area. Who knows the best are the brokers, people living there in that town, and then also the property management companies.
That's really good. You're right. So so basically you find a market and you look for reasons why in that market, like job growth and population growth
Yes,
and
yes.
what products they have right now as far as multifamily and the occupancy levels. And then once it looks like a good market, then you reach out to an expert in that market, and they're gonna confirm facts for you and basically tell you that these markets are good and why they're good. And maybe they'll send you an old offering memorandum so that you can start seeing in your little zip code products that have sold, and you can kind of get the information from the offering memorandum, right? Like you can see how they're selling it, right? And then that's going to help you kind of get the gist of why this is a good emerging market, or it could be a good emerging market.
I
And then you're
love
going
it, Bo. I'm so
yeah,
glad you brought that up. Operating memorandum. I teach that, like I said, in the academy. That is the one place, Bo, what you just mentioned is so good, because the brokers bring all the statistics, all the data to tell the investors all across USA and around the world, as the international money is coming into USA also. It's a very good time to buy right now in multifamily, even when the correction is coming next year. Looks like correction is coming, but that's the one niche, the multifamily, where people will need roof above their head, and I've spoken about it so much all over the place. So don't really be worried that much, but buy right, buy correctly. That's what we're going to dig into the deal analyzer, like Bo asked me to do. And I'll dig into that right now the key thing is that operating memorandum will show you so many statistics, so many graphs, and then you can go to the source and pull those reports out and put it in a PowerPoint presentation. I call it slide deck, credibility deck, and then you show them to your investors, because investors will only bring money to you to close the deal if they are totally sold on the market. Market. Please remember, they would like to invest with you in your deal if the deal makes sense, but before that, they want to know why you chose that market. So that's a very important part. Let's talk about now the deal analyzer. Okay, deal analyzer, lots of people look at it as a defining tool which tells us whether we should buy or not buy that particular apartment complex. Let's take a 50 unit apartment complex example. Let's just take it imaginary, in San Antonio. Let's take that. When we moved there, my company, Ideal Investment Group, we went there in 2009 and 10. Those were the heydays. We went to the brokers there, and they said, Vinny, go ahead and buy in Alamo Heights, by the way, is the place. Alamo Heights. That was the best area. And that's what we took it to our drawing board, talked to the brokers, and we could only afford C class and C minus class at that time. We didn't have too much money that we could raise. And we kept on buying C minus properties in Elmo Heights, by the way. And we doubled our money. Doubled our money. We sold everything in 2016, 2017, things like that. We just sold Seguin property north of San Antonio in 2018, even, and then San Marcos, we sold it, I think, in 2016, I think, if I remember correctly. But anyway, let's
So,
say
so let me interrupt you real quick because I think
sure,
there's
please.
some nuggets that I want to kind of unpack.
Thank you.
So,
Thank you.
so your investment group at the time, your company
Yes,
was looking for an emerging market, and you stumbled onto this area, and then the
yeah,
broker said, "This is the area. This is the submarket in the area that you should be buying in."
correct.
So now you're okay. This is why these brokers are hot on it. And then they started presenting deals to you, probably
Yep,
off market deals. They
yep,
had napkin type listings on.
yep.
And then you would get the deal, you'd review. Maybe they had an offering memorandum. Some of them probably didn't because they weren't official listings yet.
You're right. Yep,
So then when the deal looked good, then you said, okay, broker, this is what I need. I need the T12,
you
right? You need
got
the
it.
trailing, I need the rent roll.
Yep.
Okay. And then you put it into your deal analyzer from there. Is there anything else you get in the beginning other than like doing your Google tools and stuff? You get those
Very
items.
good. Very good point. No, Bo, you're 100% right. So, what we do is we also, as soon as we get the address of the property, we do a police report. We do the neighborhood scouting report. It's called neighborhoodscout.com. It's a free service if you don't need a report on that address, but it gives you the neighborhood. If the crime rate is good, bad, ugly, whatever. The other place is Trulia.com. Please use that also. We have been using that also. There are other tools, paid tools, but I don't think we need to pay for those. But the other part is you want to see the neighborhood. If it's a class, B class, C class, like Alamo Heights was A class neighborhood. So wherever you are going into any city, please do those things. The other place you want to go to city-data.com, right? Bo? City-data.com. That's where you get free stuff about demographics, about the earning power, about lots and lots of great stuff. The other thing I do with the address, by the way, every time I've done it, I've done 27 acquisitions so far. So what I do is I put the address in the Google Chrome and space and say LoopNet next to it. Even though that property may not be on LoopNet today, it might be on a LoopNet 5 years back, 10 years back, 15 years back. So that has really helped me a lot over the years to find out more about that property, some pictures of that property, even though the broker only gave me P&L, only gave me the rent roll and the profit and loss statement, but no pictures, nothing like that. Of course, I do ask the broker, hey, you know what? I live in California and this property is in San Antonio. Could you do me a favor? Could you please send me the Dropbox link to the pictures that you have already taken? Hold on, hold on. What did I do right now? I know that they got a professional photographer to go there, take the pictures. They are going to sit in the Dropbox for about a month, by the way, 1 month, as they are putting together an operating memorandum. So they do have the pictures, live pictures, very close to that day when they told you about the property. So it's all logic. I'm an engineer. I think about everything in a logical way. So I have had my brokers go to the property in Georgia within 40 minutes because it was a $10 million deal. And my broker, I said, is there any way? I know I cannot, I'm in Hawaii or whatever we were. I said, could you please get somebody sent there? I never told the broker he should go. But then guess what? He texted me in 30 minutes, 35 minutes. He said, Vinny, I'm at the property. Oh my gosh. He was at the property taking pictures because he wanted to sell the property, guys. So please ask, don't ever say, I'm not going to ask for anything. Ask and let them say no to it. That's
Okay,
how I
now
believe in.
let's go back now because there's some things that I think we should
Sure, sure.
go dive deeper in. So you pull up the property, you look online, crime looks good. It's not a war zone. You
Yep,
look for the year built. It's not too old. Now you're going on Google Earth or Google Chrome, and you're
yep,
looking at the streets. You can just map the streets, and you can look at
yep.
the property from a Google picture within the last couple of years. When you first started, you were buying certain properties. Like, for example, you might have bought flat roof properties with AC
Yeah,
units on top that you would never buy again because of the issues that you have with those type of properties, right? Like
for
if it
sure.
right, so
But
like if
just
it's
to
a
tell
flat
the
roof, you're
audience,
going to have leak issues if it's an area that
you
gets a lot of
got it.
rain.
Yep,
So you want to avoid in the beginning. We're so eager to get a deal, right? We buy these C minus buildings that we have to put so much time and effort in. Which, granted, you can make some sweat equity and you can force some appreciation, but you also have to know you're doing huge lifting, heavy lifting, right? Where now you if you know what you know now, you would not have bought those properties because there's a easier and better way that you're not gonna get the same kind of capex expenditures that you would if you buy certain properties that don't have the flat roofs and the AC units on the roofs, right? What are the
totally, totally, Bo.
yeah.
I would love to tell the audience my experiences and my mistakes. Thank you so much. Big thing also is never buy a chiller system. By the way, chiller system is another one. It's the air conditioning by the pipeline where the water flows through. So these are boilers outside the complex, and underneath the ground, the water flows through each of the units, and you can only change the temperature of the water. That's all it is to it. So the chiller systems are pretty bad, pretty bad. I have only bought one in San Antonio, by the way. That's where it was and got us in trouble, by the way, too. I can have a whole podcast on that one. But anyway, the other thing is, like Bo just said, the flat roofs. Yes, flat roofs are not good. Lenders don't like flat roofs. If you do get a flat roof, make sure it's just installed like in the last few years, couple of years, 3 years, because their tendency is about 10 years life. The worst thing can happen is in the flat roof when there is a leak around the air conditioning units. And guess what? Because it's flat roof, you never can tell in the apartment down below where the leak is coming, the water is coming. It does not tell you that the roof leak is above it. It does not, it's flat. So the water can be coming from any other point in the roof, but it's coming through the flat into another apartment. So that's the problem. In the pitch roof, that's the other, which is the best roof structure that we should look into always. Lenders like it, we like it, my all the company. We have only bought no, three flat roofs, I think, by mistake. But anyway, it's okay. But the thing is, a chiller system, only one. We are done with it. And we had problems in the foundation and everything, guys. So I can tell you from my experience. But let's talk about, yes, please go for pitch roofs and go for, even with the C minus property conditions, you got to look for the deferred maintenance, we call it Capex, capital expense reserve. That's the Capex in short form. So you're right, Bo. So
What
when
about what about like Class C properties that are like these properties are built in 60s, 70s? And I can imagine roof is a huge item, and then but probably more of a nuisance because it's harder to fix is plumbing, right? Like old pipes that run through the building. That's where you're getting a lot of leaks, and that's like probably the biggest uh, pain in the rear, right?
You
The,
know, you are hitting something very, very special. Bo, you are so right. Oh my gosh. These older properties, guys, I want to really teach everybody who's looking into these properties the 70s product, okay, or 69 or 68. Whenever you find these older properties, there is like a boom in construction. So I've seen properties 68, then 73, then 78. Look at that. So every 5 years, there is a big bust and big boom when there is a demand and people starting to build apartments like 84, 87. So like that. But the thing is, you have to put yourself in the shoes of the new property. For example, like, 73 property, it's 27 years already passed, and then 19 years right now. So 27 plus 19, wow, that's 36 years old. Appliances only last for 10 years, guys, 10, 15 maximum. Roofs only last about 15 years. So that's where air conditioning units last only 7 to 10 years. So what I'm talking about, parking lot, roof, all that, boiler systems might last about 15 years. So those things are so important for us to see a property in the 70s. When was the last time? Okay, listen to this one. You have to find out when was the last time the seller or the owners put more money into the property in capex to change the roof, to put new appliances, to put new air conditioning units, to put, all these now piping, what you just mentioned. Bo, let me tell you about it, man. No owner, let me tell you, it's the real truth. No owner is going to split apart all these pipes coming through the walls and cut the walls and then put, instead of wrought iron pipes, which tend to corrode and everything, they do it only the basis of when they burst in the kitchen or in the bathrooms. They do all the water. I've gone through it. I've gone through it many, 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 many times. So that is only happening unexpectedly. You never know when there is something going behind the wall because you don't see these pipes, and there is that leak bursting through the sheetrock, and then it's makes the whole thing. So that's why sometime I have looked for which owners have taken the time to put $10,000 per unit or 8,000. I don't know. If they're rehabbers themselves, it might be cheaper, right? But that's something we need to look at. Wrought iron pipes in the apartments and wrought iron sewer pipes underneath the building, because in the 1970s and 80s these were wrought iron. They are not the kind of PVC pipes that we see now.
yeah, so those are because that's the thing, right? Like you think you find a great asset that's in the 70s. It's got huge upside on your pro forma that your deal analyzer. But what you're
Huh.
not really thinking about is all the problems you're going to have like when every unit is leaking from upstairs, like the upstairs unit's leaking down, then you're dealing with like one problem after the other, and it becomes a nightmare.
Sure.
So I think the thing is, if it's okay, it's good to buy, see properties when you're getting started, but also most people probably overlook. Like I know when I'm flipping houses, we overlook a lot of things, and then we go, well, next time I'm gonna, for
Yeah.
example, like you know, if you're buying a house in Concord, California, do a sewer lateral, right? Like make sure your sewer is good because at the end of the deal, when a new buyer comes in, they're gonna do an inspection, and chances are, if the house was built in the '60s and the sewer line hasn't been updated, you're gonna have to replace it. So there's a lot of like those kind of items that, like in house flipping, is equivalent to investing in multifamily, where people's pro formas are lacking enough capex, and they're missing a big part of this deferred maintenance that's going to drive
Yes.
them crazy. And that's probably like the cash flows there, on paper. They check occupancies there. They do their walkthrough of every unit, but
Mhm.
they're missing the behind the walls type thing, which that is probably could be the one deal killer.
So true, so true. I mean, what we are giving today to the audience is amazing information because that can keep them out of trouble. I'm telling you, once the seller sells and gives you the keys to the apartment complex, it's your baby. It's your baby. So you got to do the very best in doing the due diligence phase of it, of course, and also having enough money in the capex budget, we call it. I'm sorry, I've been kind of moving around to get rid of the sun. We have pretty big windows in our living room here, but that's what it is. You're right. So we do need to keep that in mind. Let's talk about the deal analyzer, like we just started, and our concentration was on that. We are talking about what goes behind the deal analyzer, right? And that is one number which a lot of people are very underestimating it. I'm glad we are talking about it. The big thing is deal analyzer kind of gives you cash on cash and the cap rate. Okay, so let me talk about that. What is cash on cash? Cash on cash is where an NOI. I should also talk about NOI. And a lot of our audience probably is quite versed with it. That's the net operating income. We take all the incomes from rent, from laundry machines, from vending machines, from live. Oh, there
Yeah.
we are. I think, Bo, you just went out. You just came back in. That's good. That's good. So, what we were doing was like, yeah, we collect all the money above the line. That's the total income. RUB system, we call it, which is the billing back of the water, sewer, trash, gas, and pest control. Electricity is individually metered, and a lot of owners don't do that. By the way, that's very ridiculous. Owners should be charging it back to the residents, and that's where we look for those properties which have mismanagement, which are they're not fully utilizing all the tools. The other thing is that's total income now. Then we take out the expenses. Expenses are taxes, big time, insurance, maintenance, maintaining the apartment complex, make readies, property management fee, that's a big one. Payroll, who's the community manager there, who is the lead maintenance, their income, marketing cost, administrative cost, and contract expenses. I just listed all the major expenses, right? So we should not miss a single one, not a single one in this category, because we take total income minus the expenses, running the property equal to NOI. That's the net operating income. It's the operating income, remember. It's the operating income, not the net cash flow. Now, what's the net cash flow for the whole month is when you pay the uncle, doctor, the lender, the bank, that's the big bank, Mr. Bank, who gave us 70% loan or 80% loan, and we only put 20% down, so we have to pay the mortgage. Now, the mortgage can be interest only, which us syndicators, we always like to do that as long as they can give us 2 years or 5 years of interest only loans. You're the king of giving loans. So I mean, you can teach so much in that regard. But that's where we take from the NOI the mortgage, which could be interest only for a couple of years, or interest and principal. Remember, principal pay down. So that's the mortgage minus one more item. A lot of people forget that. And that is called the Capex Reserve. The Capex Reserve has to be taken out also before we have the net cash flow. It's called the net income.
So let me just stop you real quick. That's a
Please,
good question.
please.
That's a good question. So, okay, on our capex, the what's the name of the study which tells you, like, the roof's got a life expectancy of X, the AC units have X, so you can actually incorporate that into your capex reserves, right? Like, if I know that the roof's good now, but 4 years from now probably will need to be replaced, or like the driveway, the roadways need to be repaved. Is there a study that actually gives you those kind of, like, where you get an inspector that goes out there, like, hey, this
Yes.
is probably what you're going to need, and then you can adjust your capex reserve accordingly, so you're not caught with your pants down?
You are so right, Bo. That's called the due diligence team. Actually, you could do yourself, but you get some very savvy contractors who are doing it day in, day out to come. General contractors are the best ones, actually, and if you're I'm just kind of teaching, again, uh, in our company, I've had two acquisition companies and two management companies. So we employ outside due diligence teams in that particular market, pay them 10,000, 7,000, whatever it needs to. It's like about $35 per unit is the inspection, physical inspection we call it, and about $10 to $15 per unit for financial inspection. Financial inspection is to look at the leases. Every single lease is tallied up, put it into an Excel worksheet. If anybody needs that, example, please email me, my business advisor John, John at vinneychopra.com. We will get it out to you. And also, the good part is we want a professional. Please don't try to save money. I teach my students all the time, my partners. Don't be skimping on due diligence, few $1,000s, and you get in trouble for hundreds of thousands of dollars later. Isn't that true? You know?
Well, it's a great point, because I just did a home inspection, and I didn't know of a good home inspector in the area, so I reached out to an agent friend of mine that knows that area, and she
Yeah.
said this is the best inspector.
Oh,
And this was just a single family home, but he did this inspection. He was so thorough,
yeah.
and it cost me $356 to do the inspection. And
Oh,
I'm like, that's your ammunition to retrade the property
exactly.
in
Yeah.
multifamily. Say retrade. Can you explain retrade in multifamily?
I would love to, Bo. As a better, I'll take a live example of that same property in Atlanta, over 200 units. And I bought it at 10,550 was the contract price, right? But then I hired very great company. I build relationships, right? It's all in the networking. I asked my broker, hey, I live in California, can you share with me a phone number of a good due diligence company? There are lots of them, by the way. Sid, I talked to Sid and spent 1 hour with him on the phone call, called him at home. I didn't worry about it, and then he sent me the reports and everything. Anyway, so I got a due diligence team. They had their staff there next day, because 30 day goes by like this. the
Can
sellers
you
only give you.
put your camera down a little bit because you're a little
Oh,
bit
okay.
low?
Oh, sorry, sorry. Okay. I just
So
moved to this. I was just getting tired of holding it. How about now?
that's good right there.
Oh,
Perfecto. Yeah.
thank you. Thank you.
Yeah.
Sorry about that.
No
So,
problem.
yeah. So, what happens, Bo, is that this professional company, you sign a contract, you have to pay money up front, by the way. They don't deal with you. You pay half first, half after they give you the reports, because they don't want to just do the due diligence and then you say, oh, I know, I'm not going to buy this property. You know what I mean? So due diligence, you have to pay the fee for their time and involvement and everything. So they put together a beautiful report, Bo, which tells you what's the age left of the roof, what's the foundation like, how old are the appliances, how are the condenser units, the air handlers and the air conditioning units, how is the parking lot structure, and how is the interior. Oh my gosh, that's a big thing. Very big thing, Bo, because interiors in apartments can go from a class to a D minus class. There could be mold. There could be, water stains of leakage. There could be, the carpet needs to be changed or lamination. Appliances are so gone out, that you have to change them. So that's what we as owners in the due diligence phase take their report, and then we are able to write a repair letter or retrade letter. It's called retrade letter or repair letter, which I did in my case of $720,000. $720,000. And then I sent it to the broker. I said, broker, Mr. Broker, you saw it also. This property needs a lot more repairs than I was led to believe, right?
So can I ask you a question then?
Please, please.
So just like when somebody's purchasing a house, they'll do their inspections and we'll do what we call a request for repairs. In multifamily, we call it retrade.
Retrade. Yep, yep.
Retrade letter. Now, if my offer or my purchase and sale agreement or my LOI, a lot of times if you know you want to buy the property and you know there's deferred maintenance in your LOI, you say we will not retrade, right? So you won't come back to them. You can say I don't want to buy it after you do your inspections, but you won't come back. If you say no retrade, does that mean you're not coming back to request repairs, or can you still request repairs if you find stuff?
Okay, good point. Very good point. See, the thing is, I never write in the LOI or in the contract that there'll be no retrade. You should never write it. As a matter of fact, on the contrary, I let the broker know. I know brokers don't like retrading, to be truthful. They hate it. But the thing is, if it's a very small amount, Bo, I'll let it go. But if it's like, four, 500,000, so I've done two times retrades in my 27 acquisitions, just two times. One time I got 450,000, by the way, the one I'm talking about in Atlanta one. I wrote it to them, retrade for 720,000 or something. They wanted to give me, they knew I was right. They said, how about 300,000 right away? Right? I said, no way, no way. I want at least 5 or 550 or whatever. So they came at 450. So my price was now less, or I want that money at the closing. They reduced the price, by the way, in the contract addendum. I said, no way. I cannot reduce the price because I want to get 80% loan on the top price, which I'm buying at, but I want 450,000 given to me at the closing because I need to spend it into the property. See, so that is so important that we don't let them retrade the price. Listen to this one, guys. Everybody, don't let them retrade the price. And I stuck to my gun. I said, it's no deal. I'm not going to take 10 million 100. Now my loan is going to be 80% of that. And then, and so forth. I have not too much money left to invest into the property. So you want repair credit given to you at closing. How does that work actually? Bo, is that in the closing statement, we get a like credit. That's what it is. You don't pay that 450,000. You never pay from your bank. You have the money sitting, in your bank, but you never pay to the seller because they give you credit in the closing statement.
Now, have you ever gotten any pushback from, like a Fannie Freddie type of loan, government loan, because you're getting a large credit? They're like, well, why are you getting this huge credit?
No, no,
Okay, they don't
not
care.
at all, not at all. This was Fannie Mae loan, by the way. The one
Yeah.
I just used as an example, was a Fannie Mae loan. The other one I'm talking about right now is our property down in Lake Jackson. I got 250,000, repair credit on that one. That was about 6 million something deal. So that was fine too with the bank. They don't mind at all. Actually, they prefer, they love it that you are negotiating, because once they give you the loan, oh, I see what you're saying. Were they worried about the property condition report? Maybe you're going there because yes, yes, yes. So what happens is, very good point, bro. So in this particular deal, yes, I had to leave about couple of 100,000 with the Fannie Mae, which is my own money, right? But it was there in the escrow account. As I fixed the things, then they gave me my own money back. You're right, yes. But they feel comfortable that I'm able to get that money, and I'll be investing my own 900 into that also. That's how the deal was. Yeah.
So I think important takeaway from this too is also you found a great deal. You're navigating through the due diligence process, and now it needs more repairs. You got to strategically allow or allot for that money in reserves, because you don't want to go back as a syndicator. You want to go. You never want to do cash calls and
Yeah.
bring in the money. That, I mean, it happens occasionally, but
Oh, very occasionally in my companies, the four companies I own, and we have never done a cash call. Never. I hope the audience will say that's good, because we have the really good strength, financial strength in my companies, that we can loan that money quickly to our LLC. And then when the cash flow comes back up, we pull out the loan.
and I, and I think let me just,
Please.
we hear horror stories,
Yes,
out
yes,
there, that people put up money, and then 2 years later or a year later they're getting cash calls that they need more money because they didn't foresee these problems, and they're there, right? So
yes,
that's the
yes.
importance of underwriting the deal and putting contingencies in your capex and having a reserve for the unexpected. Because if you don't do that, you're going to run into these huge problems, and then you're going to be calling your investors. And you think after you do two or three cash calls on the deal, they're ever
Oh,
going to invest with you, even if they ended up breaking even or making a little bit of money on
yeah.
the.
They will
It's
not. They will
right.
not.
So that's when you're going through this due diligence process. You're also like doing extreme pressure testing, where you're saying, okay, we're at 97% occupancy. Let's say the world crashed and we went down to 75% occupancy. Will this asset still support itself? Will debt coverage, right? Will at 80% occupancy or 75, will this thing debt service itself? If you're able to do that, chances are, other than a natural disaster, which should be covered with your insurance,
Yes.
the risk is so minimized, correct?
That's so true, Bo. So true. We do actually, like you said, I've been buying all stabilized assets, almost all of them, 27 of them. But the thing is, you're right. You got to pressure test it, what you just mentioned. In your underwriting tool, you can actually take it down occupancy to 60, 70%. And in our formulas, it's so easy. I mean, I got from my mentor for $30,000 this one page 14 years back, right? One page, one Excel worksheet, but we have developed so many great things added on to it and everything, which just flawlessly goes from everywhere. You change, tweak a little bit here, it just changes everything. And you can look at your cash on cash, your cap rate, your DCR, your IRR, your projections, everything in there. So now we are selling it for 397. I just saw my Facebook ad. So my team is really putting together a lot of effort to get my courses, which are like for 5,000. I won't mind saying that, but I give so much to my students, which other coaches are charging 50,000, not even more than that, even, But the thing is, I want more people to learn this business, and I give all my templates, all my PowerPoints, everything I've designed over 14 years, I give it to them. But let's talk about deal analyzer. So what we are saying is the capex amount is so important, and that shows up in the COC. Why do I say COC? That's cash on cash. Now let me explain what cash on cash is, right? Cash on cash is the one factor that has kept me in the business. I'm telling you, not the cap rate, not the IRR, not anything at all. It's the cash on cash is king. Cash is king. So let me put it this way. We do the total income minus expenses, minus the mortgage and the interest and the capex. You came up with the yearly cash flow. What you can take it to the bank for yourself, or you can give it to your investors, right? Share 70/30. I've been doing deals with 60/40. I've been buying so good, 26 deals. I did 60/40 split, but now it's 70/30 because the investors, we are still getting so great deals. Sometimes we can even give them 80 first year, but then we can do the value adds, like we say, business plans. And our investors are getting 18 to 26% per year. That's darn good. And some of my investors have gotten 40%, 43. Even I just saw one yesterday. I forgot about that one. 73% in 1 year, return. And we held the property for 2 years or 3 years, something like that. But let's just go into what's cash on cash. It's the net income after paying everybody and the mortgage after the end of the year. Now, on the other side, you have to divide that income, okay, total annual income that you got, net income divided by how much you had to pay total to buy that asset. That's what it is. So, what are those costs? That is the down payment. That's the big one. 20%, 25%, or 30%. That is the down payment you paid to buy the building. Closing cost, attorney's fees, syndication fees, and then insurance premium fees, and then the utility deposits when you transfer the account into your name. All that comes in there. Now you are ready to, oh, loan origination fee, I should put that also, or loan broker fee. That is a very important part. So, and capex, you got to put that capex. If you need to change some replacement of boilers, or roof or anything, you got to add that also in there. So in other words, now you have one number here, which is the net operating income. Let's just say it is, just for simplicity's sake, 800,000 for the year. All right, 800,000 is the net operating income for the year. And now you find that you needed, for that $800,000 income, divide that by 8 million. Is that right? No, or 800,000. I'm trying to get to cash on cash of 10, just for example, whatever that ratio would be at the bottom, right? Now, if it's 10% cash on cash, we were elated. We were so excited. Hey, this is a good property. I have bought properties with 16% cash on cash. 16 multiple. Wow. 12 multiple, and those days are gone, by the way. I want to tell the investors, passive investors on this live show right now, and other syndicators and investors, those days are gone because the properties have gone in value over time, which happens, with the interest rates where they are right now, Bo, right?
Yeah.
So everything has gone up. What we talk about also is the cap rate. What's cap rate, by the way, is the value of the property. You take the NOI, net operating income, not the mortgage or anything interest, divided by the cap rate of 10. Let's say if we did that, we will get to the valuation of the property. That's what the property should be valued. But nowadays, the cap rates are 6 or 5, literally. It is. We just bought the one in Orlando, 6.1 cap rate, which was amazing. We got it cheaper because the going cap rate in that area is 5.75. So, Bo, what happened in that case was the NOI, you divide that by 5.75, will give you value of 53 million or 54 million or something like that, right? But we got it from the seller at 6.10. So actually we traded, we got sold this property a little bit better than we expected to be truthful. Fannie and Freddie were fighting to give us the loan. I think I mentioned it to you. And we were so happy because Freddie gave us a rate lock of 80,000 or something, free credit. We went with Freddie. And they gave us 3.82%, by the way. Can you believe it? 3.82, 30-year fixed, 10-year, no, 10-year fixed, sorry, 30-year amortized, and 10-year fixed with 5 years of interest only. So it was pretty good term. Our new LOI, which is out today, we'll know today, is 3.52% interest, by the way, 3.52.
Let me ask you a question. How do you determine if you're going to go into an interest only loan? What I mean, obviously we know the debt service payment is less on an interest only loan.
Okay.
Why would you want to? Why wouldn't you always want to go into an interest only loan? Because if your if your whole time is your if your goal for the property is a 5 to 7 year hold and then flip, why wouldn't you just always do an interest only loan? I mean, what's your thought behind that? I'm just curious.
Okay. Oh my gosh, that's so great, so great. But and you're coming from the broker side. I totally agree. Loan broker, interest only loans are the best loans. I'm telling you right now, if you can get 30-year fixed interest only loan, if somebody gives you at a reasonable cost, which can make you cash flow right now, and then you can increase the value adds and all, and increase income, decrease expenses. Interest only loans are the best loans because two, three things. One is, see, when we pay the principal down, what you are doing is you are reducing the balance of the loan. That's all you're doing. But with increase in value, you are building equity in that apartment complex. So actually, you are putting more dead money. I call it dead money because equity in the apartment is dead money because that is keeping you secure for sure. But at the same token, interest only loan to start with will help you to give more cash flow to the investors because you don't have to take out the principal pay down. When you sell the property in 5 years or 7 years or 10 years, your the equity would have increased to so high amount that the principal loan balance will be okay to pay at that time. See, money is worth today, then it's going to be worth in 10 years. Let me put it this way. That's a simple way to look at it also. You never want to give any money away today because you have more buying power today. You want to give or pay back the loan as far in the future as possible, if I can put it simple ways, right?
Yeah, no, that makes a lot of sense. Now let's go back to cash on cash real quick. So it's basically the all the costs for that first year, down payment, capex, closing costs.
Uh-huh.
Okay, and now say that's $1 million.
Yeah,
Okay, and then I'm taking my NOI and I divide it into it, and that's my cash on cash.
correct. 10%. Let's just assume you
Right.
divide that. Yeah.
So what am I? So second year, the second year, I increase income. My
Yeah.
NOI increases.
Yep.
So your cash on cash year two should be higher, correct?
Higher, higher.
So
Definitely.
so
Yep.
so what? How do you look at that? Like, what's kind of like your rule of thumb? Like, as you're looking at when you're doing your projections, you're doing a 10-year projection or a 5 or 7.
Yeah.
year one was a 9% cash on cash, or 10%, let's say.
Yeah.
How do you look at it like, okay, if this project's going the right way, year two, we're going to have a cash on cash of 11? Or, I mean, what's kind of the goal for that? I mean, obviously, if you maintain the 10, the investors should be all happy anyways. But how do you like kind of look at that as far as like, okay, I'm forecasting.
Oh, excellent. Very good thing. In the deal analyzer, the beauty of the whole deal analyzer structure in the worksheets and all, Bo, is that you can assume I got that property today at so much cap rate, right? And I want to sell, exit. You got to always buy the property with keeping in mind the exit, what you just mentioned, right? In our syndications, we've been selling them in 4, 5, 6 years. That's our horizon. Our investors like to get their money back, original amount plus the equity gain, we call it, right? Because all our investors are equity investor partners. So they are partner with us. They are Class A shares in the property, which means they get paid first before us get paid at all, and we give them the preferred rate. That's the other thing, right? They can get 7, 8, 9, 10% preferred rate coming to them, every month and so forth, like that, right? On a yearly basis. But then the equity gain comes when we sell the property. That's when we try to bring about 45 to 50% equity growth, we call it. What that means is, if it's 45% in 5 years, you divide that by 5, 9%. We need to grow the equity for the investors per year of 9,9999% in a simple way, right? So that's 45%. When we sell the property, we give it to them their $100,000 back, plus another check of $45,000 from the equity gain, right? Their portion. So cash flow is given during the operation of the property, which is monthly. I've been giving actually quarterly. My investors have been walking to the mailbox 4 times a year, pick up their check and deposit it. I've done it for 12 years. But with my 27th syndication with my partner, Enzo Multifamily, great people, Sapan and Veena and everybody, their team, I love them because, see, they say, Vinny, your investors have been happy 4 times a year, but they get bigger chunks. My investors have been happy 12 times in a year. I said, how? So I didn't want to make it a big deal because I said, bill pay, then my wife has to pay every month. I wanted less work for her. I like to see what's the simplicity. But now we are going with IMS, Information Management Service, which is amazing portal. They do the waterfalls, they do everything for you. And my investors have given us their account numbers, routing numbers, everything. And there we click the button and their money gets transferred into their account every month, every month, every month. So now they are getting happy to spend the money, as they get it every month. So that's what it is. So let's talk about, I don't want to go away from the topic. So you're saying, you're right, cash on cash is increasing now. Why should it increase? Let me go over that. Because in the first year, you're taking the property as it is, you're taking the rents as it is, you're taking the total income coming as this seller is doing it. But he's got some faults. I call it faults. Bad management. What is bad management? When I see a property being 97% for the whole year, oh my gosh, that tells me that this property is a gold mine. If we have 97% occupancy, the rents are low. The rents are low because then you should go right away to looking around the near neighborhood to find out for 1 bedroom how much they are charging, for 2 bedroom how much they are charging, for 3 bedroom how much they are charging, all that, right? So that is so very important, so very important. Oh my gosh, did I have 11 o'clock meeting today? Sorry about that, guys.
I think you had a meeting at noon, I thought, or
Oh, I
or
do have one at noon, and I think maybe one at 11:30. We are good. We are good. This is going to be a tremendous. We might even do it some more reruns on this whole thing through the social media with you in your group and my group,
What
because
real quick, what do people text? Can you say it again? Somebody asked for
oh,
your
sure, sure. Please text the word learn, LEARN, to 474747, or you could email directly to John, Jon, at vinneychopra.com. That's VINNEYCHOPRA.com. That's my website also, by the way, vinneychopra.com. You could please reach me there. If you'd like to participate, passively invest with Beau and me, please reach out to Beau or I, and we'll get you in our next deal also. You can passively invest with us also, by the way. In the whole Bay Area, we have about $11 trillion. One. Everybody, please listen to me. $11 trillion we have found right here in the Bay Area in retirement funds. Most of that is in the stock market and other places, but many of the investors don't know that you can self-direct your retirement plans, 401ks, IRAs, and everything, and invest into our deals. So, that'll be something. Accredited investors, we have the website, which they can go to. Yeah. For accredited investors. And if you come through pre-existing relationship, then we can take you as sophisticated. If you're both friends or my friends, then we can take you in, huh?
what we should do too, because we're already way past time, is we should
Yes,
continue. We should
yes.
continue next week,
Yeah.
right where we left off, and then what I think would be good is that we'll go through finish the tools, and then we'll start with a private placement memorandum and a
Yes,
syndication.
for
What you're
sure.
looking at.
For
What is a
sure.
syndication? Because some of you out there might want to be a Vinny in the future. Some of you might have your own business and have some money that you want to invest and you want to be passive, but some of you want to make earned income and you want to, change your career or learn how to buy apartments yourself and be the manager of and make the deal happen. And that's what Vinny does. He essentially finds it, raises the funds, negotiates, puts all the terms together. So he's going to walk you through that process too. I'd like to do that.
Yes.
I've done JV deals. I haven't syndicated my own deal yet, but
Yeah.
that's an evolution of real estate, right?
Yeah.
You could bypass, buying these single family homes. There's a lot of people that
Please,
say, "Hey,
please.
I just want to do multifamily." Because if you let's just say let's say your goal is to make a net passive income of $20,000,
Yep.
and let's say you don't have any money because you would need about $2 million to get 20 grand a month cash flow,
Sure.
in the 5% or whatever. So the only other way you're going to do it really fast, in real estate is to be able to acquire an asset, buy an asset or manage an asset or control an asset
Hmm.
like an apartment complex. Like for me to go out to Indiana and buy these small properties, to get $20,000 net cash flow, I would say I would need 45 doors, 45 houses, right? To
Houses.
get
Okay.
20, that's a lot of work.
Yeah.
Not saying that buying one apartment complex isn't, but if we change our focus and say, I'm going to look for a 50 to 100 door project in this area, and based on my projections, that's going to net me as a, syndicator, I could make 20 grand a month, no problem net on this just one apartment complex.
Yeah.
So I think we got to define our goals too, right? And so really, if the average Joe out there had 20 or $30,000 a month coming in, most people could live off that. Probably
Yep.
not you because you travel a lot, but I mean, like I'm good. I don't, right? So I'm saying one apartment, one multifamily deal could change your life completely.
Really,
One deal.
so true. So very true. But what you said is so right. And I hope everybody listening, and please share this on your social media, like, comment, and put your subscribe to our channel also, so that you can be right at 10 o'clock every Friday. Vinny and Beau show comes to you live right here from San Francisco area. We want to spread the word all around. And please look at the book. I don't have my book here. It's the Amazon top seller, international seller, syndication apartment investing made easy. 94 positive reviews. I'm just overwhelmed with just 3 months out there. It's already hitting the press. We got the audio vision already loaded. So audible.com, you can be listening to me in your car also. And my podcast shows, I think 11 episodes are out from the syndication apartment syndication made easy podcast, and also Mr. Smiles motivation talk show. And Bo has so many great things happening. Remember, join the Rebar, meet us there live in San Ramon. Bo, please go ahead and remind us again.
Thank you.
Yeah.
Yeah. So go to REI bar, BAR camp, CAMP.com, REIbarcamp.com. And I'm going to give you the code so you get $52 off your ticket. It's September 28th,
Yeah.
which is next Saturday at the San Ramon Community Center. We have Vinney live, uh, amongst other guys. Not
Mhm.
as good as Vinney, but pretty
No,
darn.
no, they're
We got
good.
Vinney, we got David Green, we got
Yes.
Daniel Ramsey. Those three right there are going to blow your mind. Okay, if you're going to listen to three people, those are the three people you should listen to. Um,
Oh, thank
so,
you.
so
Thank
anyways, there's another 7 or 8 guys that are coming that are
Yes.
extremely knowledgeable. Because
Extremely
that's how I keep.
talented people,
Yeah,
guys.
yeah.
Extremely talented. We don't want to brag about us, but come and enjoy the lunch. Boys paying for lunch also in the ticket, and then we'll have the evening hour also to interact with us and get to know us more. And we want to really bring so much knowledge to the Bay Area. A lot of other people are coming from other parts of the country to Bay Area, and we are in our backyard. So you can see us, feel us, touch us. That's the exciting part.
And also, I think too is that what I also want to compliment you on, Vinny. Yes, you have an extremely knowledgeable, multifamily understanding, right? Don't get me wrong, but that knowledge, even if I sat here and listened to your knowledge, right, and took it all in, the key is motivation, right? You
Yes.
you exude motivation, right? So
Yes.
you get
Yes.
around Vinny, every time I get around you, I'm like so excited. I think I just need to talk to you every day, right? That's powerful. That's what you need. There's a lot of people out there that are like, okay, I'm going to learn, I'm going to learn, but they never do anything with it, guys. And trust me, we all have setbacks. Nothing's easy. If it was
Yeah.
easy, everybody
No.
would be freaking rich, right?
Yeah.
But
Yeah.
if like you're not gonna, I just read a really good book, or I listened to it on Audible, David Coggins, and
Oh,
he
really? Oh, I'll
and
take that.
and
I'll get it.
the
Yeah.
guy, he talks about callous hands and a callous mind. You have to keep going, even if you get, you look at 50 deals your first year and you don't buy one.
Oh,
By the end of that year, you have gotten so much education. Let's say, day two of year two comes, and all of a sudden, boom, that perfect deal comes in. That's going to make you 20 grand a month every month going forward, right? So the key is that you just keep going, but you got to take action. Just listening is not going to do enough. You have to like
sure.
get motivated and say, okay, I'm going to start looking at apartments. I'm going to start filling out the deal analyzers. I'm going to start, you know, asking questions. I'm going to start going to meetings where I can interact with people that buy real estate and
Yep.
figure out what they're doing. Figure out which direction you want to go. Maybe multifamily, you're scared and you want to start somewhere small.
Sure. Sure.
Get started. Or
Oh,
maybe
totally.
I have a lot of friends with money, and they're like, I want to put my money, and so it's like,
Yep.
okay,
So
like you
true. So
should learn
true,
about,
Bo.
instead of putting your money in a mutual fund, at least explore the idea of investing in the syndications. But
So
before you invest
true.
in
So
syndication, learn how to vet a syndicator, learn how to vet a deal. You need to learn it and then take action in whatever way you want to go. But anyway,
totally, Bo. What you just said is so right. I do want to let you know, actually, we are starting some new websites, investing with Bo. I mean, with Bo and Vinny, or investing with Vinny. I think they got the domain name. And then also learning from with Vinny or something. My team are working very hard to give you so much ammunition, and same thing with Bo and our other friends. So please reach out. We are right here locally in the Bay Area, San Francisco Bay Area, and just reach us. find us, Google us, send us, text us. We are here to serve you. The key thing is take that decision. See, anything that in life happens is from our thinking. Thinking has to turn into action. If we don't act, if we come up with so many great ideas and then we just let it go, you got to be writing the idea right down there and put yourself a scheduled time meeting with yourself to say, I'm going to crush it. I'm going to find out why can I not do what other people are doing. See, and even start with a fourplex. Never buy a single family home. I teach that all the time. Buy a triplex, fourplex, eightplex, 12plex. You will be much further along, and then actively or passively invest in multifamily. It's the way to go. It's going to be here for a long time. USA is becoming bigger and bigger renters nation, all that, and we have statistics to prove it to you. Good luck to you. Thank you, Beau. You're an
All
amazing
right.
host. Say amazing partner with me, and let's meet again next week. Oh, by the way, Friday. I hope my timing is right. I'm also speaking in San Jose State. I've been invited by a lot of great groups of people. I was just flew down to Ontario from Salomon Niazi. Some of you, please go to Facebook page and listen to some of my talk there. We raised almost $8 million over there. I couldn't believe no, six. 2 + 4, 6 million. So it's possible, guys. Okay, thank you, buddy. Thank you so much. And Beau, I will say bye bye. Let's enjoy today. Make it happen.
All right, guys. Thank you, everybody. And reibarcamp.com, and then use Thrive as the promo code. You get $52 off. All
Okay.
right. Thanks,
Thrive.
Vinny.
Thrive is THRIVE, right?
Yeah.
Thrive.
Yep. You got it.
Awesome. All
All
right.
right. See you
Thank
guys.
you. See you
Bye bye.
again. Bye. Okay, buddy. Bye bye.